for maybe the first time, put the agenda on the screen for you for the next 45 minutes or so. And I know some of you are saying the screen's blank. That is the agenda. Feels like I have this down like every word for word, but we have no agenda here at the Mashup. So we talk about whatever we want to talk about, and if you guys don't ask questions or give me something to ramble on about for a while or any squirrels to find, then I will do that all by myself. So, and I'm good at finding squirrels, that's for sure. So if you have any questions, whether it's strategy related, technical analysis, mindset, those last two, the technical analysis and the mindset, are kind of, those are the two things I'm most passionate about, especially the mindset part. Because really trading is the most important part about trading. The most important thing to master is your mindset. In fact, I think that it is at least 95% of the battle. Because you can learn all about strategy. You can learn all about technical analysis. You can understand all of that stuff inside and out. But if you don't have the mindset down, it doesn't mean a thing. And one thing, and I don't know why I just thought of this, but I've heard this story here a few times. Some of you know who Steve Nissen is. He is the gentleman that has been credited for bringing candlesticks, Japanese candlesticks, to the West. Not sure if that's valid or not, but that's basically what most people consider is he is the one that brought them from Japan over here. They've been around for 400 or 500 years. But years ago, probably 10, 12, 13 years ago, I was watching a video of he used to do workshops, and I don't know if he still does. I haven't followed him. I don't know where he's at, what he does now, but his books are phenomenal. But he used to do some teaching and workshops and stuff, but and he recorded some, like most of us in the industry do, right? If you have something that people can take home and watch over and over and over again and get the repetition, then that is good. But we were watching, there was a few of us traders, we were all sitting together at my house in the living room just hanging out and watching this video, and he stood right there in front of a live audience. I mean, I was recording, but he stood there and he said to everybody that, he said, I don't trade my own account. I have somebody else do it for me. And it kind of took me back. And I don't know if I'd say enthralled or not, but I was very focused on what he was talking about, because he was talking about how he didn't trade his own account. He had advisors do that for him. Yet here he is getting paid big money by a lot of the big firms to give his advice, give his analysis of the candlesticks. And here he is saying he doesn't trade his own account. And then he says, the reason I don't is because I can't handle the emotional swings. It is too much. So in other words, even though he knows anything and everything there is to know about candlesticks, he doesn't have control of his emotions enough to where he can trade his own account successfully. And that was just stunning to me. And it was one of those eye-opening moments where I went, okay, if this guy knows all that there is to know about technical analysis, specifically candlesticks, but he doesn't do his own because of the emotional side, then that means the emotional side of trading is pretty darn important. Controlling your emotions, mastering your emotions, and learning how to trade calm, cool, and collected is really almost all of the battle. So that is one of the reasons that a lot of times we get very focused on the mindset side of things, because it's everything. And I learned that not only from watching him, seeing that video, but also through personal experience. Because I used to think that if I just got good enough at technical analysis, if I just got good enough at reading the charts, if I just mastered one strategy, then I'd be right 70-80% of the time and I'd make a fortune. I used to believe that was true. And then I learned the hard way that trading isn't about being right. It's about controlling risk and controlling your emotions, mainly controlling emotions. But controlling risk is also obviously a big part, which also ties into, everything, it all kind of ties together. So very, very important. So we will most likely, talk extensively about that. We usually do here. So, but got a couple questions. I just saw your first one. Here's the first question. How does the bickering back and forth between our potential presidential candidate affect this market? I think it probably doesn't, realistically. Um, it will be interesting, though, and being at this for about 16 years now, I've seen, what, 3 or 4 elections now, um, and how they've affected the markets. And it's kind of like earnings. It's hit and miss. You never know. A company could come out and blow away earnings, and they get hammered the next day, which is not uncommon. And on the surface, it doesn't make any sense. If you dig a little deeper into it, it makes perfect sense. But um, it's just weird how the market reacts. Because, I mean, honestly, when Obama first got elected, if I recall, and I have to go back and look at the charts, but I recall the market didn't react favorably. But then it bounced right back. So, I mean, you just never know. It's really hard to tell what the market is going to do sometimes. You think you know, and you think it would make sense, but all of a sudden it'll throw you for a loop. So, who knows? You would think that the market would react favorably to Trump just because of the economy side. Most people believe, and I'm not endorsing or saying anyone's better than the other. But with Trump's business background and his ability to create jobs, I would think the market would look at that and say, okay, he's probably going to be good for the economy. So, and you would think that the market would react positively to that. But then again, that's what we think and what actually happens are two different things. And the reality is, and even Trump has come out and said, we're headed for a recession. He's publicly said that. So even if he gets elected, even though he may be the best candidate for the economy, it may not matter anyway. The economy may still tank. It may just truck along. It might take off. So it really is unpredictable. And that is, I mean, getting back to, and not to hammer this point home even more, but that is one of the reasons, because the market is unpredictable and we don't know how it's going to react to specific scenarios. We have to be able to be objective and change our minds. And this, getting back into the mindset stuff, is you've got to be able to set aside what you think and manage and deal with what we see. So what we think isn't necessarily the same as what is actually going to happen. And what I've learned is that it's best not to think. Set aside your thoughts and your emotions and what you think. I mean, I'm glad you brought this up because it's a valid point. And people do this all the time, and I used to too. And I teach purely from experience, so it's not one of those things. If I say this has happened or somebody does this, I've done it too. We look at things and we go, okay, well, earnings is coming out, or Apple's coming out with a new product. They're coming out with a new iPhone. They're coming out with a new iPad. Or they're coming out with this new product. And everybody says, oh, they get all excited about it. And they think that it's going to mean that the stock's going to go up. Because they go back to the original iPhone. When the original iPhone came out and it was a huge success and Apple went crazy. And so now they think that every time Apple comes out with a new product, the stock's going to go crazy and go up. Except that it hasn't happened, has it? I don't remember any product. Of course, I don't follow Apple that closely. Some people watch it like a hawk. I don't. If a pattern shows up, then I'll trade it. But if a new product comes out, it doesn't necessarily mean that anything's going to happen. And Apple's proof of that. So anyway, let me grab get the next question. And it was. How does he handle the swings with other people's accounts? It's funny. That's one reason that so many people want to use a financial advisor. It's interesting. You can look at it from two different perspectives. People like to use financial advisors because then they're not emotionally involved. Then they don't have to make the decision. But the funny thing is that a lot of people use a financial advisor so they don't have to make a decision. Because then if it doesn't go well, then whose fault is it? You can blame it on the financial advisor. And nowadays it's easy to sue them. That's why the paperwork is 50 pages long. That's why they ask you so many questions and they do all the things, because they have to cover their backside. Because even nowadays, in the old days, especially when options were new, if you lost a ton of money trading options, you could sue your broker, and the chances were like 95 or 98% that you were going to win. Didn't matter if they had all their ducks in a row and they covered their backsides perfectly well. It didn't matter. You just walk into court and say, I traded options. I didn't know what the risk was. I can't believe I lost all my money. It was their responsibility to protect me, and they didn't protect me. Therefore, they're responsible, so give me all my money back. It's one reason they ask all those questions. You know, how much experience do you have? This, and they have the different levels of trading. And so they can cover their backside if you ever decide to sue them. But nowadays, I even see commercials on TV. If you lost money in a mutual fund, even mutual funds now get sued. Even though they used to, and one of the reasons, and I don't want to go too deep into this, but part of the reason I know some of this is because I don't necessarily like to say this too loud or admit it, but I was a broker years ago. I started out with a different company than BetterTrades, but another similar company that's no longer around. It's been gone for a long time, but after about 18 months, somebody said, you know what, we need a broker. And this is back in the days before internet trading, where we used live brokers most of the time. Most trades were done over the phone with a broker. Somebody said, hey, we need somebody like you that knows what we're doing. Why don't you go get a license and become a broker? I went, yeah, that'd be kind of cool. I thought it'd be fun. And so I did it, and it was fun for a while. But it was funny because I went through an entire class. There's 2 or 3 different books you have to go through. You have to read and learn about bonds and all this other stuff that I could care less about. But I would say 60, if not 80% of the material that you go through is nothing more than CYA. It is nothing more than legalese teaching you how to protect the firm from liability. Has nothing to do with trading, has nothing to do with the markets. I went through a week-long class. And the first thing the lady said after introducing herself, she said, my name is, I can't remember. And before we even get started, she said, my job is not to teach you about the markets. My job is not to teach you about trading or even all the different instruments. My job is to teach you to protect your firm from liability, and then they will train you on what they want you to sell. So first thing was, I'm going to teach you how to cover your firm's butt, who you're working for. We're going to cover their backside first, liability-wise. And then we're going to let them teach you what to sell. Brokers, financial advisors are nothing more than licensed salespeople. That's all they are. And their job is to sell what the firm tells them to sell. I met a few in the industry that kind of went against the grain. And one guy, the firm would put out a recommendation. They call the client, say, hey, this is our hot stock of the week, buy this one. And one of this guy's clients was smart enough to recognize that, hey, you notice every time we buy a stock that your firm recommends, it always goes down like the week after? And he says, yeah, I do notice that. So he said, look, I want to short it. I want to short that stock. The next time you guys come out with a recommendation, we're going to do the opposite of what your firm recommends. And they did. And the funny thing is they actually made money. And then he started doing it with a couple other clients. And then all of a sudden the firm noticed it, what he was doing, that he was doing the opposite of what they were recommending. And all of a sudden he gets a phone call. And what do they say? They say, what are you doing? We recommend a buy on that stock. And you're having your client short it? What's wrong with you? He said, hey, we're making money. That's what we're supposed to be doing. Aren't we making money? No, that's not your job. Your job is to sell what we tell you. Your job is to call your clients, recommend the stock to them, and get them to buy that specific stock. He kind of shook his head. He's looking at this going, there's something wrong with this. This just isn't right. Because he was helping his clients make money, yet the firm was coming down on his head saying, no, you just sell what we want. And the reason is, and you've probably all heard it before, but a lot of times the firms make a ton of money by buying and selling. They trade constantly. And so when they have a huge holding in something, what do? If they're up 10 or 20% on a stock, here's our recommendation. It's a buy recommendation. So they send all their clients to that specific stock and they unload what they have at a profit. Now, people will say that doesn't happen. It's not really true. Then explain to me why that would happen. Why would they come to him and get angry when he does the opposite, when his job as a financial advisor is to make his clients money, and he was doing that by doing the opposite of what the firm recommended, yet the firm got cranky. Another guy, same type of thing, started trading options with his clients, started just doing basic covered calls. A guy came to him, this was, went to a workshop. I met this gentleman, he was a broker, and started talking to him a little bit. And he worked with Edward Jones. And he said it was a similar story. He had a guy come to him that had gone through the workshop, said, look, I've got $250,000, my brother has $150,000, so we have $400,000 between the two of us. If you want our money as our broker, then you need to go through this workshop. It's $4,000 to go to the workshop. He paid the $4,000 to go to the workshop so he could get the guy's money. He went to the workshop. He'd been a broker for 8 years. He said, I'm just blown away. He said, I never knew any of this stuff. I met brokers doing seminars that had been in the business for 20 plus years, and they said the same thing. I can't believe, how did I not know this? But this gentleman went back, started doing basic covered calls in these two guys' accounts, and Edward Jones, after a short time, said, what are you doing? Can't do that. He goes, it's covered calls. I mean, it's the safest, if you will, quote, safest strategy there is. Doesn't matter. We don't do that here. You can't do that. If you keep doing it, you're gone. And he goes, we're making money. I'm making my clients money. That's my job. Nope, it's not your job. So anyway, financial advisors do not necessarily have your best interest at heart. And that's why you're all here, I assume, right? But what about the Clinton scandal? What do you mean? Which one? Are we talking about the current one or the one from, or the dozens from the past? I mean, and which Clinton are we talking about? I mean, they both have plenty. Did she lie or not? Really? That's not a serious question, is it? Yeah, that's a good idea to fire him. So. No, Deborah, I did not. The firm did not limit my trades when I was a broker. I got lined up with, fortunately, I understood all this stuff beforehand. I mean, the options trading, all that, and I got aligned with a firm that did options trading. We did the type of trading that we do. That was really, and that was the thing I was looking for. I knew that I couldn't go to a big firm like an Edward Jones or anybody else because their focus is on mutual funds. I mean, that's what they sell, and the reason they sell that is because that's where the money's at. In fact, I'll never forget. I mean, I'd been at this place. And I was a month in, is all. And ING, I think it was, called me. Some representative from there called me one day, and he's like, "Hey, we got this new mutual fund. We're doing this and this and this, and we got a guaranteed 10% rate of return or something like that. And if you don't get it in the next 5 years, we're paying a 5% commission on it." And I started thinking, and I'm going, wow, because honestly, there's no money in options trading as a broker. And this is 2001, so 15 years ago. There wasn't really much money in it then, and there's none in it now for a live broker. Because you're just taking little chunks. We were charging, I think, $75 a trade. Which I know some of you are like, you look at it now, people go, well, I can get it for $10, I get it for $7. And for those of us that have been around for a long time, we're looking at it going, $10, $7, peanuts. Because it was, and $75 was cheap. That was dirt cheap for a trade then. I know guys that were paying $200 and $300 for a 10 contract trade. $200 and $300. That was fairly average, actually. $75 was a steal. But making virtually nothing, I mean, when you're doing $75 trades, and my cut, I think, was like $15 as the broker, the firm kept the rest. I mean, you got to do a lot of trades to make a decent amount of money as a broker. And so here's this guy calling up saying, hey, we'll pay you 5%. So if I can find a guy that's got 50 grand wants to put it in this mutual fund, I just got a $2,500 paycheck. One client, $2,500, or one client with 10 trades in a month, I'm making $150. Which one are you going to take? I mean, you look at it from a broker's perspective, if you're looking at making commission. But the thing is that the mutual fund had a 5-year holding period. And why do they have a 5-year holding period? Because they take the 50 grand in, they pay 2,500 out to me. They only have 47.5 left. They want that 5 years to make their money back. Not to mention all the other fees they're charging. So anyway, how do we get off on this? We covered that enough, huh? Oh yeah, yeah, Merrill. The big firms typically, if you're with Merrill or Goldman or any one of the big names, a lot of them they don't allow you to, and the reason is liability. It's that simple. It's just because they have to cover their backside. So that's basically it. So should we look at some charts? Anybody want to see if there's anything exciting happening? Let's go look. Take the next 20 minutes or so and do that. So, oh, look at that. You don't even hesitate. ABT. What is ABT? That's not Abbott, is it? Oh, it is. Okay. ABT. Let's see. Now we've done the fun stuff. Let's get some analysis in here and have some super fun. What about ABT? Is there anything specific or just curious to know my thoughts? Let's see. Get some lines drawn on here. What just happened? Where's my back? I don't know what's going on there. Goofy programming stuff. Okay. Nice little double bottom there, right? Upside to fill in the gap. Oh, that gap right there. Yeah, it looks like it at this point. I mean, after yesterday's candle, up $1.39 with a decent increase in volume. Kind of sort of have an inverted. Wait, that was a weekly. That's why. I would say we have an inverted head and shoulders there, but that's on a weekly chart. There we go. On a weekly, we have an inverted. I'm going to draw this line and see what it looks like on a daily. Yeah, that's a ways away, though, so I'm going to take that off. But will it fill the gap? I mean, it looks like right now it wants to. Which is how high will go if it goes up to 44. Reverse island? If it gapped up today, where's it at today? Let's do a quick intraday update. See where it's at right now. Or at least within the last 20 minutes or so. Whoa, man, you're firing them off. Yeah, I can see. Let's see what indicators look like. Yeah, wow, there we go. Okay, there's today too. Today's following through. You can see we've got, and there's interesting. We've got a little bit of divergence on MACD. You notice the price. Let me zoom in here so you can see a little better. Notice the lows on the price have gotten lower. This most recent one, just a week and a half, 2 weeks ago, was about 37. It's just a few pennies lower than the other one, but MACD, the lows are higher. So MACD is going the opposite direction of price. And then yesterday we had a big breakout to the upside. We broke above the two most recent highs, so we've got that double bottom going, rallied, a little bit of increased volume, but a huge candle. Also, we've got basically a rising three methods there. You can see, where's the box thing at? It's not on there. I think it's shifted around. But basically, rising three, it's actually technically a mat hold. You take out today's candle. Yesterday was the confirmation day. So we should have a continuation from here. Today we're breaking above the 200-day moving average, as you can see there. So this looks bullish right now. Here's the challenge with this, is it's already moved so far so fast in the last couple days. The odds of it continuing to run, it's probably going to have either a pullback or it's going to move sideways for a few days. That is what the odds would say. Because generally speaking, after a couple days, you can go back to here. There we go. Grab an arrow. You can go back to there. Hopefully you can see that. It's not real dark. Let me make that thicker actually. I'll make it red and make it large. I don't want the arrow to be large. I want the. There we go. That should be more visible. You see there we have a similar type of rising three. What happened the next couple days? It gapped down and then kind of went sideways for a few days before it continued to rally. So typically when you get a big move, especially, this thing's moved from, a week and a half ago was 37, today it's at 41. So it's made a huge move. The odds of it continuing to run like this get smaller and smaller with the higher it goes. So if we're looking just purely at odds, then this is something I would wait on. Either wait for it to hopefully pull back to about 40, and then look for a move from 40 to 42 and a quarter, 44 maybe. Because if you get in right here, where's the exit? If you're going to control your risk, where's the exit out behind you? It's all the way down here below 40. If not even, those two tops are 39.66. So the exit's so far away that there's just a ton of risk. So hopefully that makes sense. I would wait on this one myself, just because it's just too much risk. So let's go see if Google. What do we got with Google going? Kind of a double, almost a triple top. We sort of kind of broke through the midpoint. Okay, there we go. Well, if it goes below about 700, pretty decent chance of going to 600, it looks like. Question is, will it do that? So let's see, indicator-wise, if we go back here, just look at the long-term picture. I'm kind of bouncing around a lot here, but so we've got the 50 crossing over the 200, which hasn't happened in quite some time. It happened back here, what's that, 14? A year and a half ago? And then it just went sideways for a little bit. It didn't drop off that much. But this looks ripe for a drop. Everything it's kind of set up. The only thing that would be better is the bands, if the bands were pinching, which if this goes sideways for a few days or a week or two and the band, then it breaks down, that would be ideal. Whether or not that happens is hard to say. But, that line's at 704 basically. If we break solidly below 700, there's a decent chance of getting down to 608, 610, 600 maybe, somewhere in there. How long it takes is the next big question. So let's take a look, because this is actually one that we could, it's possible. Let's just set up a practice trade, if you will. So basically, this is the way, for those of you that haven't seen my trading style or how I worked, and essentially what you'll see is, number one, we just did the analysis, right? We've got a stock, so we've got a candidate. The analysis is there, long-term, short-term. It looks like it wants to go down. It looks like it's going to drop down. So if it does break below 700, then I want to get into a bearish trade, whether that's buying a put or a bear call spread or whatever option strategy you take. Personally, I buy calls and puts. It's neat, it's clean, it's simple, it's easy. So I'm gonna speak in terms of just buying puts. But the first thing I always do is, what's the risk? And that means, I don't know why that just disappeared. I don't understand what's going on here. We've had some glitches lately. So the first thing I always do is, where's the stop at? Where am I going to get out? Okay, I'm expecting this thing to drop. I'm going to plan for a drop, be prepared for a drop. But if it does drop down below and it gets past my point and I get into the trade, and then it turns around after I'm in the trade, at what point am I no longer confident in a move to the downside? That is the question I ask with a stop. And so essentially what I'm looking for is, because this is one of the biggest questions, is where do I place stops? We've got the support / resistance about 705. And so if it breaks down and I get into a trade, but then it goes back above 705, I have to pick a stop out point where I no longer believe that it's going down. So looking at the most recent action of the last 3 or 4 days, I'm going to put it slightly above those shadows because we've got to give it enough room to wiggle. Because one thing that we all do, especially when we're starting trading, is we put the stops too tight because we don't want to have a lot of risk. We're not necessarily looking at the risk in terms of how much risk we should be taking. We're looking at it in terms of dollars of this. I only want to risk $300. And that's okay, but we have to frame it and have the right perspective when it comes to, okay, I only want to risk $300, so how many contracts should I do? Usually what we do is I only want to risk $300 and I'm going to trade 10 contracts, therefore I have to give it 30 cents is all. Which you should all know with Google, it's $700. That's unrealistic. Some stocks you can, but the reality is that we need to calculate risk based on what the analysis is, based on what the chart shows us, and the phone's going to ring a few times. Sorry about that. We've got to base that risk off of the chart and the technical analysis side and what happens. Is that you calling? That's not my cell phone. That's a landline, so in the background. But so we've got the risk calculated. So there's a stop. The next one is, where's the target? And it should stop there. So I'm going to put the target just shy of the support level. So that way, if it doesn't quite get to that spot, then that's okay. And now, give me just a second here. Bear with me. Your screen should have just gone blank. Give me just a second. I'm going to go pull up this file, I think. And where is... I lost this last time. I thought I found it. There we go. I think, come on, where is it? I've lost my, I don't know how I lose that. I'm looking for my risk reward calculator. Oh, there's one. Okay. This, I don't know if this is a newer one, so we'll find out. Yeah, it is. Okay, good. Good. Okay, let me bring the screen back on for you. I thought I had this up. Now I'm going to clear all this out real quick. If you haven't all seen this, this is basically just it's a simple spreadsheet I threw together just for to keep things simple. And all I have to do, I just created it because I got tired of doing it by hand. So I punch in the numbers, 7:15.9 needs to stop, and you can see it's all color coded, 6:13.11. Whoops. So then the entry point, I can't stretch that either. Doesn't show the risk. The entry point is 695.34. So I'll come over and do 695.34. I'll duplicate that. 695.34. Make it orange so all the colors match. Okay, and it pops back up there. And what you'll see here is that with the risk reward, and that risk is not, that column's not wide enough, and it's all locked down, so I can't open it up right now. But the risk should be about $18 or so. $20? Yeah, it's all just shy of $20 actually. So essentially what this does is just calculate out numbers for me. So it's a 4-to-1 risk reward. So in other words, I've got $4 of upside for each dollar I have a risk. You see the reward there, 85.20, potential I should say, potential reward. So the risk is about $20. So you have about $20 of risk for $80 of upside potential. Now granted, this is off the stock price, so the options are going to change, going to reflect that. But the beauty of this, and most of you have seen this, but for those of you that have not seen risk reward and why it's so important, this is one of the biggest things that will help you control your emotions that there is. Because think about this, because like I said earlier, that when I came to the market, I went, you know what, if I can be right 70 to 80% of the time, then I'll be golden. The thing is that we don't need to be right 70 to 80% of the time. And the reality is that you're not going to be. I don't care how good you get at reading the charts. You're going to be wrong more often than you're right. And it's not necessarily that you're wrong. It's just that the market did something different. The market doesn't do what we expect. And so it goes a different direction. And so it just is what it is. This whole right-wrong mentality is deadly in the market. And so once you see this and you fully can really just grasp it, and it took me a while to figure it out. But if you have 4-to-1 risk reward, if you have $4 of upside for each dollar you have a risk, you don't have to be right but a little more than 20% of the time. And some people say, that's crazy. Because I say, well, what if you could be right 25% of the time and still make a profit? That's crazy. That doesn't work. Well, if you just think without running numbers, and if you don't believe me, go test it. Just get some paper out and do it yourself. I used to show it, but not anymore because people don't believe me. So I say, take it and test it yourself. So if you have $4 of upside and $1 of risk, so think about 5 trades. If you do 5 trades and you have $1 of risk on each one and then $4 of upside, you have 4 trades that go against you. You lose $1 each. That's $4. You have 1 trade go in your favor, make $4 profit. So you made $4 on 1 trade, you lost $4 on 4 trades. So you made 4, you lost 4, you're break even, right? But you only had 1 out of 5 trades work out in your favor. 1 out of 5 is only 20%. So you're right 20% of the time, or I should say the stock goes the direction you thought it would 20% of the time, yet you're still break even. It's kind of mind-boggling, isn't it? But once that sinks in and you realize that that actually works and you go do it in reality, because I've had several people say, that's crazy, that can't work. And then they go do it themselves, they test it, and they find out, oh yeah, it does work. I had one gentleman says, I didn't believe you. He sent an email. I don't believe you. But I've just done 37, I think it was 37 trades, paper trades. And he said 29, I lost on 29 of them. So he had 8, I think it was 29%. That's why he was 29% accurate as far as which ones went the way he thought they would. 29% accurate, he was still profitable on 32 or 37 paper trades. And he goes, you've made a believer out of me. And it's really just simple math. It's simple statistics. And when you see this and recognize the power of probability and how big of a deal it is, and then you realize how much control it gives you over your emotions and how it helps you just calm, because all of a sudden you go, I don't have to be right that often. And all of a sudden you stop out of a trade and you go, who cares? You shrug your shoulders and say, it's no big deal. Because that other trade that I have on, if it goes in my favor, yeah, I lost $1.50 on that. But I can make 6 on that. And if I make 6 on that, I'm still up $4.50. I'm golden. You take a deep, just sigh a big breath of fresh air and you go, don't care anymore. Just do your thing. Just have one of them go in my favor. Out of the 5 trades I just did, just make one of them work out and I'll be happy. That's all I can say. If you're sitting here shaking your head and you're going, yeah, I still believe that, go do it. Go test it out. So I'm going to look at LinkedIn real quick and then call it a huge gap on LinkedIn. That looks like a buyout to me. And yeah, Mike, going back to your reverse island, I think we said that if that gaps up, which one was that on? That was on was it ATL or something like that? And I meant to say something then, and I just obviously you know why you gave me the shirt. um, ABT, thank you. If it gaps up, if it was to gap up, say tomorrow, then yeah, you'd have a reverse island, absolutely. Did LinkedIn get bought out? I don't know. It looks like it. That's what that looks like. Honestly, this is, and people say, how do you not know? Well, I don't really pay attention to the news anymore. And if I'm not trading the stock, then, oh, really? It's not a huge surprise. So, interesting. $190 a share. How many would have liked to have options at, stocks at 130, the next day you wake up it's at 190? Be pretty nice, right? But interesting, I didn't hear that yet. So Microsoft bought out LinkedIn. So, but see, the funny thing is I stopped kind of paying attention to the news just slowly, and then all of a sudden realized it wasn't affecting my trading. So I just kind of gave up on it altogether. So, but with that, I have got to sign off early today. So for those of you that haven't seen this, if you're new to either the Mashup or if you're not familiar with the tools that I have done over the years, over the last, I don't know, 6-7 years, Patterns and Flash is all technical analysis. It's all about charting. We've got the flashcards, which is designed to train your eyes to recognize the patterns in the charts, whether it be a price pattern or candlestick. And it's all about repetition, right? So I did this years ago for myself when I was reading books, because back in 2000, 2001, all we had was books and workshops. Well, I'm reading books and I'm learning about the patterns, but I'm not able to see them in the charts until it's too late. So I was getting frustrated not being able to see them on the right-hand side of the screen. And one day I was sitting on a plane and I went, you know what? We used flashcards as kids for math, and I wonder if it would work for, I don't see why it wouldn't. So I threw it together for myself and boom, it worked. And literally 2, 3, 4 weeks, and I was starting to see the patterns on the right side of the chart more clearly. And once you do that repetition, you spend just a few minutes a day, 3, 4, 5 minutes, you start to see them. They'll literally start to jump off the screen at you. It's almost like you're looking at a chart and it's like it's waving. Look, I'm head and shoulders, and it's waving its arms at you. So just a simple tool that will help you do that. But then as I developed it, I realized that the flashcards were just the first step, because recognizing the pattern is only step one. If you don't know what to do with the pattern, once you found it, doesn't mean anything. So there's also videos. There's 6.5 hours of video in there about not only foundational information that's important. So if you're brand new to technical analysis, or if you're still learning, even if you're advanced, if you think you're advanced at technical analysis, there's a lot of stuff in here that I've had some students that have been around for years that finally got patterns that flash. They went, no, I'm more advanced than that. I'm beyond that. I don't need that. And a month later, they sent me an email and go, I didn't know a lot of this stuff. And realistically, I don't care how advanced you are, it really comes back to the basics. Trading is very basic. You can get off into the advanced stuff and get into the weeds, and the reality is you come back to it's just simple basics. The trade setup we just did on Google today, that's as simple as it gets, and that's how I trade. Find a setup, find something at a support or resistance, or that's at a pattern, set a stop, a target, risk reward, and then just let it do its thing. And if Google drops and hits that entry point, pull the trigger on it, forget about it, don't worry about it, and let it do its thing. I mean, that's essentially what I do. So you've got 6.5 hours of, you got the flashcard, 6.5 hours of video. That spreadsheet, the Excel spreadsheet is also in there. That's a bonus. There's 5 or 6 different bonus things that you will get also if you get one of these tools. The other one, Advanced Trading Mindset, was the follow-up that is all purely about mindset. That's also about 6.5 hours of video. It's just a coincidence they both ended up about the same time frame. But there's basically 6.5 hours of video all about mindset. So if mindset is a challenge that you have, then I would suggest getting that one. If technical analysis, you need help or you just want to get better with that, get Patterns and Flash. They are independent tools. You can get them both. You can get them separately. And you see the pricing there. It's $299 is normal price, but here at the web shop, you get it for just $229 for either one of them, or both. You can get both of them. It's just double the price. And then notice at the very bottom, it's not technically $229 per quarter. It's $229 when you first subscribe. But if you, at the end of the quarter, if you resubscribe, if you renew it, it's just $99. So you can keep it active for just $99 each quarter. So I know we've had, I've had a lot of people over the years say, well, why don't you just make them DVDs? And we've talked about it. We've molded around, which producing DVDs and shipping and all the costs involved with those, it makes the price higher. They're $4.95 to $6.95 for DVDs. But then the downside of DVDs is they're not mobile. These two products are mobile. You can look at them on your phone. You can anywhere you're at, because they're right through your My Account page. So you just log into BetterTrades.com. You can access them. You have them mobile. You can't put a DVD inside your phone. And so by keeping it digital, it lowers the cost for you, and it makes it more accessible. So it's more versatile, and it's a lower cost. And the nice thing is honestly, get it for a quarter. Beat the heck out of it. Get it to a point where you have it down, the material down so well that you don't need to renew it. I mean, that's the ultimate goal, is not to have to renew it so you don't need it for more time. But I've got a few people that have had it for 4 or 5 years, and they have it just for reference. They just renew it because it's only $99, so they just renew it every quarter. They have it there whenever they want it or need it. So something to consider. But all right, with that being said, I appreciate y'all coming and hanging out. Appreciate you throwing out questions and stocks and stuff. So we will see you all next week. Y'all have a great day, great rest of your week, and great weekend. Y'all take care. Bye-bye. Rest of your week and great weekend. Y'all take care. Bye-bye.